There we go. If everyone will take a seat, we'll get started. Welcome to the second panel. My name is Chuck Laven. Been on the faculty since the beginning of the program. Actually joined the faculty here in '81, and great to see old friends. Thank you, thank you. So I'm not going to introduce our panel in the interest of not taking up more time. Their bios are in the book. Dawn and Mary are on the faculty now, and everyone knows Hank. I just want to make a special vote of thanks. Hank has been an extraordinary colleague to work with for the 30 years, I guess, I've been on the faculty at Columbia. And he had the insight that I think is most important, that the right place to teach real estate development, and real estate finance is in an architecture school. It was a premature insight. For a while you were alone. So thanks to Hank. I'm going to make a very, very quick introduction of a few issues. I love the panel on density, and I was trying to think about what does it mean for those of us in the finance area. It means we're going to have to figure out how to write larger and larger checks, and that may be a real difficulty. So just a few things in looking back over 25 years. Interest rates, for those of you who joined the class in '86, we were in a temporary spike down. They went back up a little bit, but we basically have been in an environment of 30 years of declining interest rates. If you happen to have bought real estate in the 1980s and 1990s, and you bought it at cap rates of 200 or 300 over some index, by the year 2006, you were obviously brilliant.
You refinanced it 5 times.
You refinanced it 5 times. And so whether you were a brilliant real estate developer or whether you just happened to ride a curve for 30 years is a tough question. One other thing, oops, I'm going to come to that later. That's the depressing one. Whoops, the slide doesn't have what I wanted. So in the housing industry, it's been pretty interesting. We put too much capital into housing, say a lot of people. We've put tons and tons of capital into housing, and it has been, the traditional cyclical business. Hank will take us back to '86 when there was a big spike up. In '81 when there was a big spike up in interest rates, '86 a big spike up in starts, a big spike up again. But the really interesting thing is the far right hand of the chart, where starts have gone as low as they ever been. That chart I think ends in 2009. It goes down even further. And how we recover from that is going to be the question of what goes forward next. One last sort of macroeconomic slide. There it is. Building real estate is about finding lots of capital. Capital is basically the Federal Reserve and what's the U.S. monetary base. And as you would well expect, the U.S. monetary base, continues on a relatively even, long, slow curve. As the population grows, as things happen, we expand the monetary base. You'll see a little uptick there. Money flowing into the capital markets when long-term capital went under, when the Russian debt crisis took place, and when the CMBS market collapsed for the first time. And you look at that blip, and that was a huge disruption in real estate markets at the time, in August of '98, if I remember right. And then look at 2010 and what we've done over the last 2 years since '08 in expanding the monetary base. For real estate finance, what happens in the future, and I think we want to try and think not only about what happened for the last 25 years, but what happens in the future. I always put this slide up because I have no idea what it means, and it makes me very nervous. Any curve that looks like that. And so yeah, there's something bad is going to happen. But it does mean in the real estate world, there is an awful lot of capital available because the monetary base has expanded so much, but credit standards have tightened so much, finding it is a problem. And so we're going to have three panelists who will speak about those issues and how we do it. Mary first, and then Dawn, and then Hank to wrap up. Let's see if I can figure out how to get your slides for you, Mary.
Oh, thanks.
I can see how this comes out.
Thank you. And just, you're using the click, oops, you're using the clicker or the, I got it. Okay. Good afternoon. And we were asked to go over 25 years of capital markets. And as some of you who have been in my capital markets class, who's I see in the audience, I will admit a few of these slides you've already seen because they seem perfect for what we were asked to do today. This is a real estate development. So this is, as some of you know, this is my favorite slide. Basically, you got to have dreams. Someday this guy is going to own a whole slew of caves. Okay, these are some quotes you've probably seen over the course of the recession. And you may have seen on the front page of the papers a few years back, Warren Buffett was starting to buy again because you've got to be greedy when others are fearful and fearful when others are greedy. Little real estate history, going back about 25 years. A lot of you may not recall when you had about 800 thrifts, affectionately called savings and loans, that went out of business. That's what started the RTC, the Resolution Trust Corporation, that took them over and had to figure out how to get rid of all this stuff. And that actually is what started spurring securitization and commercial mortgages being sliced and diced, because all of a sudden, towards the end of the 80s, the RTC said, what are we going to do with this? So investment bankers hopped in and accounting firms and helped them figure out how to slice and dice, and that really was what started the CMBS market. But going back a few years, you had a Tax Reform Act in '86 that was putting the kibosh on tax shelters. I actually was, till about '84, in a real estate tax attorney, and I was doing a lot of tax shelters. That's about the time I got out of the business. I actually transferred into Solomon Brothers, into real estate finance on some deals I was working on, because I was going to have to learn a whole new tax code, and I really did want to be an investment banker anyway. And that was my window period to make the switch. So that year kind of sits in my mind. Just didn't want to learn a whole new tax code. Then in '87, you had the major crash, which was nothing compared to the one we had a few years back. And you can go on and look at a lot of these different things. '94, '95, you had the Mexican flu and the Asian flu and the Russian flu and long-term capital. You know, Crimea, by the way, has been probably the first and only major REIT that ever really filed for bankruptcy and stayed and really never really came back. You all know about General Growth. They filed, they came back, they're doing fine. Okay, if you all remember Y2K, we were all worried on New Year's Eve on 2000, were we going to be standing in an elevator, and was the elevator still going to work? And remember, we were all schlepping gallons of water home. I still don't remember why, but we were told we had to have water in our refrigerators. And anyway, you had September 11 and et cetera. You had a lot of consolidation with REITs, with REITs buying companies, with companies buying REITs in 05, 06, 07. Of course, then we all know 07, 08, you had the subprime blew up, and you had Bear Stearns acquired by JP Morgan and Lehman bankruptcy, et cetera. All throughout this, real estate actually has done okay. It's not, some parts of it aren't doing great. We're seeing more and more of a bifurcation between the good properties and the bad properties, between the good companies and the bad companies. And the bottom line is those who have liquidity are doing the best. Now REITs, which a lot of you know, that's my shtick. I'm a REIT analyst at Moody's. And they were actually formed in '60 by an act of Congress. And you started out, and really what got them going, you had mortgage REITs in '69 to '76, and they kind of put a bad name on REITs because, as a lot of you who have heard me say, I've never understood mortgage REITs because it's really a spread between what you borrow at and what you lend at. And if anything's going to get in trouble between you and me, it's always the mortgage REITs that seem to get in trouble first. So you'll never see me running a mortgage REIT, I can guarantee you that. Really, in '91 was when Kimco was the first REIT to start the new generation of REITs. And then you had a lot of the other companies come out of the box right after that. And right now we find REITs are getting larger and larger because it means you have better access to the capital markets and, again, liquidity, which is the bottom line. And basically, since we were asked to talk about 25 years, really it's four, and I tend to think of things in groups of fours. And it's really securitization, globalization, consolidation, and technology are really what has changed over the last 25 years. Securitization, really you're just creating a synthetic tradable security whose performance mirrors the underlying asset's performance. It has made the market a lot more liquid. It has allowed a bit more transparency. Of course, CMBS did have its hiccups in the last few years, which a lot of you know. Don't blame me, I'm a REIT analyst. The CMBS people start in the office next to me. So, but I will say, they tell me there's a lot of deals in the hopper for year end, and there's actually some deals in the hopper for January, February, despite the hiccup that happened in August when some other named rating agency found that they had a hiccup in their model. Starts with an S, ends with a P, but I didn't say anything. And basically the CMBS market came to a halt for about 3-4 weeks in August, early September, because Goldman had about $1.2 billion, $1.3 billion deal that was going to go out, and 12 hours before the deal was going to go out, that other named rating agent or unnamed rating agency realized they had a hiccup in their model. But they had to do that, by the way, because we're all highly regulated companies now. And basically, if they didn't talk about, before it went out to the investors, if they didn't bring this to light beforehand, it would have been a real mess afterwards, because you would have had these bonds sitting in the hands of investors that were mispriced. Oh, by the way, I'll give you a little hint. We weren't invited into that deal. I know we bid on it, but the investment banks didn't like the spreads of my colleagues down the hall. Fast forward, at the end of the day, when the deal got repriced, it was at the spreads that my colleagues had originally quoted and didn't get invited to the party. But I'm not saying we told you so. Supposedly securitized real estate does have a bit more liquidity, some diversification, competitive rates of return, lower volatility typically than other asset classes, and it does provide somewhat of a hedge against inflation. Globalization. We've had a lot of globalization with the real estate going on, and not as much as we thought would happen, but we've had a lot go on over the last 25 years. You do now have REITs in a lot of major countries, in London, France, of course Australia, where they have a lot of REITs. Hong Kong and Korea is starting it, etc. We've even actually rated a few deals. I've been on rating committees with my London colleagues. South Africa has started a few REITs also, and Brazil is starting it up as well. So, and interestingly enough, the REIT model throughout the planet is typically based on the U.S. model. Variations on a theme, but typically based on the U.S. model. And of course, a number of our companies here, whether they're public or not public companies, have been going overseas and building and acquiring companies and to have other platforms. Oh, while we're on globalization, I did want to read you one thing. I guess you all see on the subway in the morning, AM New York. It's great paper. You can read it while you're standing up. Well, Todd Harrison is the CEO and founder of Minionville. I don't know if you've ever seen that website. It's a great financial website, and it's kind of tongue-in-cheek, but very good, and they've actually won some Emmy Awards and other awards for this website. I just want to read one paragraph that he had yesterday. He says, he's talking about the global flu that's going on now. What's more, the overseas situations aren't isolated. While Greece is only the size of Massachusetts, much of its debt is owned by Portugal, whose debt is owned by Italy, whose debt is owned by France, whose debt is owned by Spain, whose debt is owned by Germany. This is similar to the first phase of the crisis, with Greece as Fannie Mae, Portugal as Freddie Mac, Italy as AIG, France as Wachovia Bank, and Germany, which owns them all, assuming the role of Lehman Brothers. Thankfully, the rest of the script has yet to be written. Consolidation. There's been a lot of consolidation. Some of our smaller companies, whether public or private, have been taken over by REITs. You have REITs that have gone private, and then they've gone public. A great example is Archstone, which acquired the apartment company that acquired Charles Smith, the Washington-based company, around 2000, 2001. They then continued public for a while. They went private around 2006 or so with some money from Lehman Brothers. And then they're probably going to go public at some point. When you see Scott Sellers, the CEO, on panels at NAREIT and on a lot of other panels, we're all assuming at some point they're going to go public again. But basically, the good part about the last 25 years, you have a lot of different structures in which you can put a real estate company. Technology, a lot of you know about this better than I do. The hard drive on my computer at the office crashed yesterday, and I called my help desk. I was telling everybody 4 times till I got a human being down to the desk. Our help desk at Moody's is now run by a subsidiary of Dell out of Dallas. Lovely people, but when you need somebody to look at your hard drive that's crashing, you need a human being there. But basically, you can look at apartments, you can look at properties on the web, you can analyze them. It's really, really spurred up how you look at, how you evaluate, how you do due diligence, and how you buy properties. Everybody knows my big shtick is the 4 quadrants: debt, equity, public, and private. And the good thing about the last 25 years is really companies, if you're a public company, you have access to all 4, which clearly helped the REITs through the bad times in the last few years. When the markets closed in 2007, they started taking out more mortgages. When it opened up in April of 2008, with Simon Property Group issuing the first bond in about a year, about 10 months or a year, and that started up the market in April of 2008. All the companies have been going to the unsecured note market again, but they can get mortgages or they can do term notes. The nice part is there's flexibility over the last number of years to go to a number of different places for your capital. Growth in number of REITs over the last 25 years, and as you can see, when the REIT market after 91, Kimco, I just mentioned before under history, was the first REIT in the new era, you could see how it popped up. And then with some of the consolidation that's happened in the ensuing years, you know, you went up to about 226 REITs at the height, around 95 or 94, and you've come down to about 160 now. Now this is equity REITs as well as mortgage REITs. And market capitalization really follows what we've seen in the marketplace. Again, 91, more REITs starting up. Now the market cap as of the other day, is about $448 billion. Definitely come up from when it was way down in 08, 09. Again, financing, you can use a lot of different sources. Basically, I guess the purple bar on the end is a lot of the companies have been issuing equity to finance some of their acquisitions. The little blue one is the unsecured note market, and then the little yellow bar is preferred stock. This is just showing you the performance. I didn't have statistics from NAREIT for more than 10 years back, but just showing you how some of the REITs have been performing. If you see lodging, as you know, when the market goes awry, lodging goes awry. And industrial, when you see that downturn, we call that the Prologis effect. When Prologis, what was the largest industrial REIT, which now has merged with A&B, and when that had a hiccup a few years ago, and their market cap went down about 90% at least, it really hit, there's only about 4 or 5 industrial REITs, it really hit everybody. Just to give you an idea of what REITs are doing versus some other industries, there are some years, 09, the last few years of 10, they've really been, doing quite well. And of course, this year, they've had some good months, they've had some not so good months. Just to give you our overview on what's happening in the REIT market, we pretty much, our rating outlook on all of our major food groups right now is stable. I will tell you we also cover prison REITs. They're doing good too. Great business. There's about 3 of them. High occupancy. Definitely not a lot of moving in and moving out. And typically these are REITs that basically what happens is the states or the federal government basically lease the properties from the prison REITs, and of course they pay. The only problem is when you have the federal government or state who tells somebody, who says to a prison REIT, we want you to build a prison for 800 people, you know, right there, and then all of a sudden the state runs out of money and you have this building, which you can't use it for a lot of other things. I don't know if you'd want to move into one for multifamily. You know, it kind of has barbed wire around it. So alternative uses are somewhat slim, but it has great occupancy. Multifamily and lodging, though, the fundamentals of the business are great because, as you know, multifamily, you can barely get an apartment in Manhattan these days, as well as across the country. And lodging has come back because business people are traveling again. Yep. This is just our strength. Just going to mention that we think the market, you know, pretty much the whole sector is pretty stable. You know, there's some good diversity. And the problem with REITs is that little capacity for rent cash retention. The reason being is they have to pay 90% of what would be their taxable income out to their shareholders. So when you got to pay 90% out, you don't have a lot of cash sitting in the coffers. That's why they go back to the market a lot. To end, what I love about this program is, and I was just telling some of the people up here, is that all the students are so passionate about real estate and passionate about what they're going to be doing. But you have to remember one thing. The passion is great, but at the end of the day, you need cash flow, and that's what the last number of years have shown. Thank you. Whoops. Do you want me to just, yeah.
Hi there, I'm Donald Sheets, an adjunct here at Mesred, teaching, I guess now for the last 3 years, what's been a fairly new elective called Distressed and Alternative Investing. So a very fine point to the capital markets, very focused class. And I guess the theme of what I would speak about today is everything old is new again. Vishaan was giving me a little heat about wearing this cardigan sweater today. I thought it might be a little emblematic of the fact that things that are old kind of become hip again. And distressed investing today was certainly a sleepy industry for the majority of my career, but today, judging by the number of students who want to take the elective, it's kind of hot. And on the themes of that, I think Mary raised several interesting facets over the years of what's affected our industry, capital markets, all the way down to individual assets. I'd like to maybe hit on some themes that are old again, or that are old that are very new again, and the fact that, you know, history isn't necessarily repeating itself, I think, today from where we were in the late 80s to early 90s. It's certainly rhyming. I'm not going to have a slideshow. I'm probably just going to walk through some high-level thoughts and some tangible examples. Otherwise, I'm not that good on PowerPoint, despite how young I am. I'm probably one of the crankiest people when it comes to technology. So the securitization markets, while Mary had mentioned, certainly boomed in the 90s. Were actually created in the 1920s. I'm not sure if anyone's quite aware of that, but before the Great Depression, in New York and in Chicago, there were developers that were securitizing individual office buildings for their construction and were selling bonds to the public markets. So securitization isn't necessarily anything new. It's been around for quite some time and has busted consistently when the macroeconomy takes a radical shift. Just like some REITs or developers securitize individual assets today, large malls, large office buildings, it's nothing new. Securitized assets go all the way back to Amsterdam in the 1600s. I'd like to dispel a little bit of the notion that the regime change of securitization, it's certainly much larger than it's ever been, but it's been around for a while. Dispersing risk, I think, is the overarching theme there that should open everyone's eyes, and that's the heart of what securitization is. So when we went through the collapse of the early 90s, securitization was used by the resolution agencies as a method of moving assets off of the government's balance sheet into the public markets when the public markets had no appetite for it. So a little different than the developers in the 20s that were looking for cheap capital. The government in the 90s was looking for a market clearing price. And the sheer volume of mortgages that were held in the RTC mandated that securitization was really the only viable opportunity. So there is when we really saw what we consider the modern era of securitization, like Mary had mentioned. But that theme, think about it. Who had anything to lose and who had everything to gain from securitization? And the model back in the RTC days was that there was real skin still left in the game. Buyers of bonds typically had to take subordinate positions so that there wasn't necessarily an inordinate amount of risk transfer between those that put together securitizations and those that ultimately held the risk. And that would be the overarching theme that certainly became pervasive when securitization in the 2000s became very Main Street. For those that take the class, there's a bunch of opportunity when you're looking in securitized bonds. But I would say that the market, from my perspective, is going to remain weak in the near term, despite there being kind of a false start in 2010 and 2011 for securitized bonds, certainly absent the theme of risk matched with actually some economic incentive. So, as many of you may know, in the 2000s, the real winners in the securitization markets were the entities involved in simply putting the deals together. No different than late 80s in terms of syndicate, or actually the mid 80s in terms of syndications that Mary was talking about. Real estate was merely the asset that was being bundled, and it had nothing to do with property dynamics. It had everything to do with fees along the way, contingency payments, and so what you saw was a fierce reaction in the 1986 tax code to what was being a very abused structure where there was little risk in the game in terms of constructing office buildings on complete spec, which was pervasive at the time, merely for large tax shelters. What you're seeing today is not necessarily the government interfering in the securitization market, it's the private markets. It's bondholders saying, if there's no one that really has risk here, then why would I buy these bonds? Why wouldn't I originate a mortgage myself and hold it on my own balance sheet? And that's the dynamic we're going to see. The forward pipeline for securitization, as an example, in 2012 is only $15 to $20 billion. That's about 5 to 10% of what we saw each year in 2006, 2007. It's really small. So I would posit that the capital markets for the next several years are going to rhyme a bit to what we saw in the 90s. We had a bit of a false start recently, but it's going to be a bunch of upward momentum here where it's not going to be so easy to necessarily dispel risk. My class, very different, I was hearing the density presentation earlier today. It really covers real estate through a second derivative, which is not investing in assets, but investing in structures or opportunities that are certainly asset related and have everything to do with real estate, but investing in real estate non-traditionally. And what I would say is, again, the theme that we've seen over the last 25 years is that there's a consistent market opportunity there for those who are able to transact in the space and have the capital to do it. So just like in the RTC days, those that got in early on buying those RTC bonds or buying distressed assets coming out of the resolution trust did well. And what we're seeing today is a very fragmented market where perhaps the best opportunity isn't in buying assets. Maybe it's buying the debt on those assets. And that's certainly the opportunity that we see today at the private equity fund that I'm with. And the theme that we see is that there's a massive mispricing still in the capital markets today on the ground. There are assets trading at levels that wouldn't necessarily reflect where we think the capital markets are, i.e., if you could go and buy a mortgage on an asset versus buying the asset itself and realize, let's say, a 10 to 15% unlevered return, what return would you then require to buy that asset? North of 20, 25? That's not where assets are trading today. It probably doesn't speak well for those in terms of wanting to get into development specifically. I would have a bit of a very bearish view of where new supply and where new development is heading in the next couple years as a result of the fact that the capital markets are seized and there's a massive mispricing on the ground. So that theme again of what's old is new again, I'd like to maybe spend a couple minutes on what would this conversation be like 10 years from today, or maybe at the 50th reunion of Mesred, rather than harping on the past. Where will we be? And I think 25 years out is pretty hard to fathom, right? We would look at Chuck's chart and look back 10 years from now and see this upward spike in terms of the M1 supply. I would absolutely agree. It's frightening, right? But let's fix that spike as of today. Where does it go from today to year 10? And what are we looking back at? It's unprecedented in terms of money supply in the world today, and we're certainly seeing it play out across the Atlantic. But a lot of us in the US may be misperceiving the risk of what's actually here and viewing what's happening in Western Europe purely in the abstract and not focusing on problems here that pretty much rhyme with what's happening in Europe. Very, very high levels of leverage, not just at the sovereign level, but let's talk about it at the entity level. While you'll see kind of a barbell in the corporate markets, there are AAA rated companies that hold a bunch of cash, but those aren't necessarily emblematic of our economy. And I would say that we're in for a massive de-levering here, and I don't think anyone really knows what that looks like. Coupled with Chuck's chart with the spike in terms of the M1 or the liquid money supply, I'm not quite sure the de-deflation that everyone was thinking about in 2004, and even up to last year, if you can believe it, very, very smart economists and a lot of Fed members believed that deflation was a risk. I'm not sure how you could look at a chart of spiking M1 and ever think that deflation's a risk, meaning that inflation is a huge risk. And what does that then mean for our industry? Mary touched on a point, and I think Chuck also, that cap rates or kind of asset values as a proxy are highly dependent on a spread typically to either junk bonds or US Treasuries. And if those rates are rising and rising rapidly in the near term, what does that mean for asset values? And what does it mean for the capital markets? I think that we've got a little bit of a false complacency, especially in the US. And we could be in for a larger surprise than we think, and we could be sitting here in 10 years looking back and saying, this was so obvious, and how could I not take advantage of it? How could I have perhaps sat on my hands and not invested in property today, or perhaps invested in property opportunistically through debt or through some other avenue? Some themes that we speak about in the class are those avenues, right? How can you short commercial real estate exposure? And that may be the glaring opportunity today, is if you believe you have a negative bias in the property markets, then let's find a way to potentially profit from that with a negative view. And it's only been recently that in a liquid market, you can actually take a negative bias on property. And that's where I see the opportunity for the next several years, is in blocking and tackling in the senior level of the capital stack, meaning buying debt, or shorting property. So unless we find that our governments intervene again and put restrictions on short selling, either through stocks or through CDS, there's a glaring opportunity, and maybe we'll be talking about that in 10 years, where if you had a negative bias, that may have been the real market opportunity. So a bit non-traditional, a bit thought-provoking, very different perhaps than speaking of density, but a very, very focused opportunity set we would see today is in looking at what looks obvious and putting it fast forward and seeing what that might look like in the rearview mirror. So with that, I'll hand it over to Henk.
Without criticizing some of my former speakers, I come from what is known as the real world. And so I had an experience with a Chase Manhattan Realty Investment Trust. They were a pretty good outfit. Ray O'Keefe ran the front door, and Chase Manhattan Realty Investment Trust ran the back door. You would never go to Ray O'Keefe with a bad loan. Of course, that would be the last time you did a bad loan or any loan with the Chase Manhattan Bank, and probably any other bank, because Ray would call and say what you did. So if the loan was no good, you went to the back door. And then the back door took 54 bad loans. 54 out of 55 loans went bad, but not one for Ray O'Keefe. So you got to understand the background of the real estate investment trust. They can't compete with the bank in the front door. They got to get extra money, they got to have extra risk, and they have to have extra problems. That's my analysis of that. Now, what about the times we've had? Well, I'm going to go back to 1976 and tell you that in the last 32 years, up until 2008, we've had 6 of these events, just like we have today. And maybe the others were even worse. Now, how could anything be worse? Well, let's start out where it wasn't so bad. We had Jerry Ford, who became the president after President Nixon resigned, and he lasted 21 months, and he was a Republican that protected Republicans. So forget about the cities and forget about jobs and anything else. What he did was give us the Sun Belt subsidies so that any house that was available down south got a credit on the bottom line of their tax return. He also did another thing. He opened the back door, this was a good back door, for only selective builders who knew when the door was going to be open, and only to his friends, where he gave 30-year mortgages at 6%, while the market was at 12%, and the banks were paid the difference for 30 years, almost up to today. And so that was our benefit from Jerry Ford. And so he finished up, we had 12% interest. Then after that, we had a little problem at that time, something called gasoline. We had no gasoline in the South, in the North. The South had all the gas, and there were bumper stickers on the cars. A lot of you may be too young to remember, but it said, "Let the damn Yankees freeze in the dark." Right? And so here we were with a city where we had hundreds of thousands of people commuting into New York that had to abandon their houses or they didn't have a job. Can you imagine? We had, beyond a certain exit on Long Island Expressway, no one. You went up to Yorktown Heights, it was gone. You went beyond that, forget it, there was nobody there. So even policemen and firemen had to abandon their homes because they couldn't get to work. Well, so much for that. Then we came to another little problem. A fellow by the name of Jimmy Carter was the president. Poor Jimmy. He didn't know which end was up. And so he was supposed to be a nuclear expert. We didn't need a nuclear expert. We needed a guy who could prevent what we got, 21% interest. Could you imagine a real estate, any business, could you imagine a real estate business with 21% interest, 18 to 21%? I'll be nice. So a city like New York got into real trouble. And a good thing came out of it. Well, first of all, Felix Rohatyn, who was still alive and a great, great man, came up with MAC bonds. And we paid interest up to today. Some of those bonds are still hanging around, 12 to 15% to get money to keep the city alive. I'll tell you why in a moment. And we did one other thing. We pledged the sales tax. That was all foreigners know that you come to New York, you buy in Saks and Bloomingdale's and all that, Madison Avenue, that the sales tax was good, and so we pledged the sales tax for all of the years that the MAC bonds were around, that money would go first from the sales tax to that. And he was pretty good, because he figured that out. But we had 82% real estate tax collection. Who could own a home, own an apartment house? Who could own an office building in times like that? There was a little thing in the middle that just had to do with New York City. New York City changed the building code, the zoning code, and everybody wanted to get in under the zoning code. And so we had buildings going broke just because there was too many apartment houses went up on 2nd and 3rd Avenue on the east side. So we were getting along all right. Then came President Reagan, a Republican. He didn't know, I don't want to use the word from Shinola, but you know what the other word is. He gave us the worst sock in the head you could get in the real estate business. He eliminated accelerated depreciation, which we all live by for tax shelter, and he eliminated doctors, lawyers, and Indian chiefs from being able to invest in real estate. That was the end of the shopping centers, the end of the office buildings. All we were selling, Larry Wien and his friends and everybody else, was selling smoke, selling the tax shelter. You got 14%. Do you know what the tax rate was then? And we're complaining today? 70%. The income tax rate was 70%. And nobody complained about the rate because we weren't paying it. We had other ways to get around it. So we got President Reagan, who's really set this business back a long way, and takes a Republican to do that. Reminded me of Eric Cantor from our class. Then came the crash in October on a Monday in 1989. I can't forget that because I owned a brand new 50-family apartment house in Palm Beach on the ocean. And I had just opened the sales, and I had 5 contracts. By the end of Monday at 5 o'clock, I had no contracts. And that was a shot. But by January, the stock market came back, and the buyers came back. It was a 90-day catastrophe. Well, this is not a 90-day catastrophe right now. This looks like it could go on, but I got some good words to say. So here's 2008, and we're struggling. We're really unhappy. But anybody who knows me knows I'm an optimist. I was born that way, I'm going to die that way. And so if you read today's paper, Horton, that's the company that almost bankrupted all of Arizona and especially Phoenix by building hundreds, if not thousands, of houses that were vacant. They made a profit this year. They made a profit this year. What did they do? Anybody in my class here today? Anybody from my class? No? Well, I can say anything I want then. But I have been lecturing that you, and everybody here says, you can't make money at the top of the market. I agree. You can only make money at the bottom of the market. And you can only make money on cheap land. If you can get in and buy the land now at 10 cents or 20 cents on the dollar, I don't care how long this takes, you're going to come out smiling. And they bought cheap land. Read the paper. They bought cheap land and made their profit on the land, not on the building. And they're out of the woods. And they have signaled what should start coming. In New York, we got a completely different experience. We built condos galore. We took Carlyle Partners, one of the finest finance companies around, and they built five buildings, empty. So they got pretty smart. We can't live like that. They rented them out. The rents in New York have skyrocketed. You can look in today's paper. You want a 2-bedroom apartment to rent, and a small 2-bedroom apartment, and it doesn't say 2 baths or 1.5 baths. It's $4,395. If you want a 3-bedroom apartment, which we don't build very many of, it's about $6,000. It is, and there's no vacancies. People are running around looking for apartments. There are none. And so what is going to happen? The little fairy is going to come and change those rentals to condominiums as sure as God made little apples, right? You can see it. And we're back in the saddle again, at least in the people who thought they were really wiped out in those condominium markets. Had to live for 2 or 3 years, and if they didn't lose their buildings, they're going to be in good shape. Look, we have, look at me, we have increased life expectancy. But you see baby carriages on the street. You see family formations. People can't live in 3 rooms with a new baby. It doesn't last. Either the marriage goes or they have to find something. I'm not kidding. And so we're going to see movement. Now, what happens when the kids get to be 3 to 5 years old? You got $30,000 a year to send to private school, for nursery school? No, you go to Scarsdale or somewhere out in Jersey or somewhere else where there are good school systems and you pay real estate taxes of $12,000, $13,000, $15,000, and you get 2 kids free in school. And that happened always and will now happen again. And so now I want to move to the bargain world. Something new is happening. In the midst of all of this, the Bronx was a food market. The Bronx market on the 140s and the Major Dingan Expressway is swamped. It does have a lot of security, but it's swamped. It's got all the Home Depots and the Costcos and everything else you could think of. And on 120th Street, brand new on the east side, we got the same thing happening. And just about 2 weeks ago, so that's related. By related, I mean properties. And so 2 weeks ago, Peter Ratner opened up Ridge Hill in Yonkers. You got to see Ridge Hill. There is $100 to $150 million put in before they open the doors. And they got medical office buildings, they got stores galore, they even got LL Bean coming into New York, and they got the Cheesecake Factory, and they got apartment houses going up. I won't comment too much on what you see when you look out of the apartment house window, but there's a cemetery right there on the high floors. But you know where you're going. And if you want, I have to have a little fun, I can't be serious. And if you want to see something really interesting, go to Red Hook and see IKEA in the, excuse the language, the ass end of the world. It's going to come back. It's going to bring a whole new world to a dead area. And it doesn't need the water, although it has a ferry to get to IKEA. They're running a ferry. So I think there's new patterns of development. We've changed our buying habits, though, and you better watch out. I'm not really computer literate, but I know to buy on Amazon anything I want. My wife reads books 2 or 3 a week, and she splits it between Kindle and the iPad. And the reason she doesn't like either is there's no numbers on you don't know what page you're on. But they'll cure that someday. And you can't look at the back to see what the end was. But don't look for Borders anymore, and you won't see Barnes & Noble much longer, because that's changed. And if you want to buy an espresso coffee machine in Bloomingdale's, you've got to be out of your mind. You're going to buy it on Amazon. You'll look at it in Bloomingdale's, and you'll take a sample of the coffee, but you're not going to buy it there. So what I'm saying is this technology that's coming, well, we've had catalogs around for a long time. And L.L. Bean made it on catalogs, right? Anybody ever go to Freeport, Maine? Discount place. But you don't go to this discount place. You go to the retail store. By the time you're all done spending your money, you might get to the discount place. But the whole town of Freeport is a discount place. But that's not new. Anybody been to Woodbury? Well, every woman should have gone to Woodbury, my God. I mean, every department store, every major chain, Armani, Chanel, you name it, Ralph Lauren, has a store there. And supposedly you're getting last year's merchandise. The fact is you're getting merchandise built and designed for you up there. And there is merchandise sprinkled in from their regular stores. But you can't get a parking space in 3,000 to 4,000 cars on a weekend or during the week. And there's buses loaded with immigrants going up there. How's my time? Okay. So what's going to happen? Just like happened once before. One-horse towns, one-horse cities are going to get in trouble, or if they're not in trouble already. But the big major cities, the ones that have 24 hours day and night going, theater and everything, they have come back and have schools, hospitals, libraries, museums. You can't kill them. You can hit them, but you can't kill them. And that's the reason why this New York City comes back. But the one-horse towns are dangerous. And anybody who wants to go to a small town and do it, just look at the post office. That post office in a small town will be gone, and that was the center of the town. The post office, people congregated the stores around the post office. That's over. We got a problem. IBM, Apple, Nike, you name it. General Motors are having things built in China. General Motors is keeping its cars. It's going to be the biggest car manufacturer in China. But the other people figured out that China a long time ago was the 51st state. We would make cheap stuff there, pennies on the dollar, bring it back here, and sell it for whatever we wanted. Buy a pair of Asics sneakers that are a minimum of $100, $4, $5, and to cost to make it. You won't see any leather products made that saves Louis Vuitton in China because there are no cows. And pigs make tough leather. Too thick and too much work. The point I make is we're not only worried about China, we're worried about Mexico. We moved our factories on the other side of the border because we pay $35 a week instead of $12, $15, $18 an hour. While we're at it, I want to talk about that. We've devalued our dollar at least 2 times. And the reason we've devalued it is to fool the public. So the worker in Pittsburgh who was getting $25 an hour all of a sudden was getting $16 an hour, but he didn't realize it. On the world market, he was getting $16. On our market, he's still getting the 25. So we could get away with that. We reduced them to $12 on the world market, so we could compete on the world market. The Chinese have done just the opposite. They have pegged the renminbi to a point where no one can do business with them. Now, I don't want you to laugh. I promise you that you will want to laugh. We have a problem with our deficit because they have $1.33 trillion of our bonds, right? And do you know something? This is not the funny part. They're buying up businesses as fast as they can. They know they can't get their $1.33 trillion back or cashed in. They don't dare do that. So they're buying in slabs of $8, $10 billion at a time. And it takes a long time to spend a $1.33 trillion. They're buying our businesses, which is very smart. And here we go. How did we get to owe them $1.33 trillion? I'm way up in the finance part here. And, well, the answer is when you have a unbalanced trade, you got to make it up somehow, and that's how the bonds come about. That's how the evenness comes out. Now have a laugh. Their biggest trading partner, China, is Europe. And it isn't the bonds that are held by France that are in what, I'll try and quote. It isn't from that paper. It isn't the bonds that are held by Greece that are in Spain's bank account. It's all in the Chinese bank account. And don't smile now. I told you not to smile. They got a big problem. They're going to bail out Europe. They have no choice. They are the holders of it all because of the imbalance in trade. Okay. One other thing. What happens to the $1.33 trillion? Well, when we started borrowing it, there was 10 years ago, it was 6.73%. And for 10 years and 20 years, it's 6.80%. Today, it's 2.73% for 10 years, and 2.80% is what we pay on Treasury bills today. And so I don't know how, I'm not good enough for that. I don't know how that factors in to what it really means. Now I got to go to the real part, as long as I got the time. What do we do to get out of this mess? I'm not going to talk about real estate, because real estate comes for the ride. If we get out, everybody's out. Well, we have a certain group of people that want to reduce the deficit. I agree, but not now. And I'll tell you how to reduce the deficit. We're at 9%, no reduction. When we get to 8%, a little bit. When we get to 7%, a lot. When we get to 6%, you don't need to worry about it. We'll have a surplus. Our GDP will be wonderful. Everybody's worried about we're going to go down. We had about 2.5% gross GDP increase this year. And if we get to 3 or 3.5%, we'll smile. It'd be a crime to put more people out of work. 1 million people are on the line just in the private sector to put out of work. Now, I don't argue. Maybe they're not working. Maybe they don't work 8 hours. I don't argue that. But we can't afford to take the soldiers that are coming home and the people that we're going to put out of public service jobs on the street. We'll have riots on our hands. So, well, for a long time we had a deal going. We let the rich get richer. Even at 70%, they got richer. And we divided the company up into really 3 pieces. Very poor, think they're middle class, and rich. Okay? You ask anybody, what are you? I'm middle class. You got a job? No. Oh, what do we do? We lower our head. We go to work. We don't fool around. We make the Chinese pay because they can't do anything to us. By the way, I had 3 PRC Bank of China students a few years ago, maybe 4 or 5 years ago. There's a woman was in my class. She walked out when I said something. You're there, I see you. I'm sorry for what I'm about to say. I'm not sorry, but I apologize. They said to me, we have a problem. This is 5 years ago. What's your problem? I said, are you talking for the Bank of China? They didn't answer me. I said, now you got to talk to me straight. I got to know who I'm talking to. They said, yes. They said that we built cities. They called it communities. They didn't say cities. We built communities for the middle class. But we don't have a middle class yet to fill the cities. Then they said cities. And we have a problem. We haven't raised the wages fast enough to create a middle class. And what do we do? Well, I said we had this once before with the Reconstruction Trust Corporation is referred to. We took all those buildings back. We packaged them up, and we sold them in bulk. We sold apartments, we sold land, we sold one-family houses. We sold everything in bulk out, and we got rid of it. And they said, we can't do that. And I said, why? And they said, we'll lose face. How do you run a banking system where you're going to lose face? So they got their problems. Now I'll finish. How do you catch a falling sword? That's where we're at in the real estate business. How do you catch a falling sword? Got to have gloves, very thick leather. But we know you can't make money at the top of the market. No one has ever made money at the top of the market. Everybody thought they made money at the top of the market until it changed. And I proved to you that it's changed 6 times in 32 years. So this is nothing new. I see people walking around saying, is this ever going to end? Listen, we went through this so many times, it will end. But what are you going to do to make money now? You can only make money as it bounces around on the bottom. You can only make money if you do your homework. You can't walk in. You got to be extra careful. Now is the time to buy cheap and good land. I know of a golf club that was offered $80 million, and today is going to be sold between $5 and $10 million for the land. Yeah, that's interesting. So this business is one long ride. You got to know when to get on and when to get off. Thank you.
So thanks. We're going to just end there. I'm going to just one final note as kind of a challenge for those of us in the finance industry, having being in an architecture school and development. And the conventional wisdom in the finance industry has always been that great architecture, great urban design, great development makes money for the third owner. First guy spent too much building the building, gets repossessed by the bank, who sells it for way too cheap to the third guy. And so part of the challenge for us in the finance business is to see if we can change that equation a little bit. In fact, the last 4 or 5 years has seen that and seen some great architecture actually getting financed and making money the first time. And that's, I think, our hope of this program and what we're trying to do. So we're going to take a break, Kate.
Yeah, we're actually not going to take a break, if that's okay, just because I don't want to have to cut short the drinks part of the evening, which I know would really not make people happy. So I think we'll just swap out and bring our last panel up, if that's okay with everybody, and continue right on. We have about an hour of three great speakers, and then Vishaan's going to wrap up as a prelude to cocktails, I think.
I think I'm gonna invite people to sit here, and then to come up to the microphone. I think it's the easiest way, kind of the way that they did it.
Who wants to? I don't know how my slides are going to come up.
That's a good point. There should be. Where's the clicker? Let's see.
Here, that's the clicker, isn't it? The mouse.
Looks like the clicker.
No? Yeah.
Yes, but I don't know.